If you've been trying to figure out how people are still buying in today's market, you're not alone. Between higher interest rates, rising prices, and everyday expenses continuing to go up, a lot of renters are feeling like homeownership is just drifting further and further away. While affordability is tight in most cases, it doesn't have to mean that homeownership is out of reach. You just need a good strategy. Today, I'll be sharing 6 practical ways to make homeownership more affordable, even when rates aren't ideal. Let's dive into it. Most people start the home buying process a little backwards. They'll jump on Zillow or Redfin to start browsing, fall in love with the home, and then get pre-approved and get shocked by the payment, and that's when panic sets in. But when I have my initial consultation with clients, one of the questions that I ask is, what is your maximum comfort payment? This important number tells us so much because once we know that maximum comfort payment, not the payment that you think you should afford, then we can reverse engineer everything else. We can find the right price point, the right loan structure, and the right strategy that fits your life. We also look at your all-in investment, and this is what we also would call cash to close. But we don't really use cash in the mortgage world. Everything needs to be sourced, but this number includes everything for your closing costs and your down payment. When we understand your maximum comfort payment and how much you have available for your all-in investment, we can then strategize and design a plan that works with your life and your budget. The next thing that we'll look at is comparing the maximum comfort payment to what you currently pay in rent. When you compare your maximum comfort payment to what you're currently paying in rent, you can then take a look at your budget and see if there's any other small adjustments that you can make to create more room. Now, this doesn't mean that you have to cut out everything that you enjoy, but it's just these small little intentional adjustments. Maybe you'll make coffee at home a few days a week rather than buying it out every single day. Or cook just a few more meals at home rather than catching something quickly on the way home. Or just simply skipping a couple movie nights each month. These little changes, not big drastic ones, can compound quickly over time, and this can create some breathing room and can help you get to homeownership faster than you think without feeling so restricted. When you design your home buying journey around a payment that feels good and a budget that supports your goals, affordability becomes much more achievable, and the process feels less overwhelming. Now let's consider property types. A lot of buyers believe that if they can't afford a single family home, then maybe it's just not even worth attempting to buy. That's just simply not true. The smartest move, especially in higher cost markets, is to start with something that's more attainable, like a condo or a townhome. These options have lower purchase prices usually, lower maintenance because you have HOA dues that are helping with the exterior maintenance, and sometimes even lower monthly costs because sometimes those HOA dues will include utilities, but they can still help you build equity. And it's really important to remember that statistically, the first home that you buy usually isn't your forever home. It's a stepping stone. It's an entry point that will help you stop renting, start building equity, and eventually move into that home that checks every single box. I've helped so many clients follow this exact path, and it's exactly what my husband and I followed as well when we entered into homeownership. My clients will look back and say, I'm so glad that I didn't wait. And I can definitely say that we can attest to that same sentiment as well. Now, with thinking about your all-in investment, one of those factors was your down payment. And even though there have been low down payment options for years, there's still a very common myth that most buyers think you need to have at least 20% down, or you should have 20% down before you even start to consider homeownership. And it's just simply not the case. A lot of buyers purchase with low down payment options, as little as 3% down, or as much as 10% down, or somewhere in the middle. And yes, low down payment options, anything less than 20%, or anytime you have an FHA loan, it will come with mortgage insurance. But here's something that's also not usually considered in this case is that in most cases, mortgage insurance can be written off very similarly to mortgage interest or your property taxes on your income tax return. Every tax situation is different, so make sure to run it by your tax preparer. But this definitely can make a meaningful difference in affordability. Low down payment options aren't something to avoid. They're a tool, and that tool allows you to step into homeownership sooner while still being able to keep some of your cash reserves in savings. Another powerful tool that can help with affordability is a rate buy down. There's two different types. There's a permanent buy down and a temporary buy down, and they both work very differently. A permanent buy down reduces the interest rate at the beginning of the loan and stays in place for the entirety of that loan life. With a permanent buy down, you pay upfront to lock in a lower interest rate, and it's also called buying points or paying points. A temporary rate buy down, on the other hand, is exactly that. It's temporary. And there's different types of temporary buy downs. One can last for 1 year, 2 year, or up to 3 years. It gives that immediate breathing room, which can really help when you're adjusting into your new home. With the temporary buy down, that money is set aside in a separate account. And each month, a little bit is withdrawn from that account to offset the difference in what you're currently paying to what the true amount is that you should be paying. Now, if you refinance or sell before you exhausted all those funds, whatever's remaining in that account will be applied to your loan balance. On a permanent buy down, that's just that one-time upfront cost. There is no recouping those funds if you sell or refinance. Now, something to note about the temporary buy down. If you are considering that, I highly recommend comparing it to a 5-year adjustable rate mortgage, where the temporary buy down will last anywhere from 1 to 3 years, and it's very possible that your interest rate will be adjusting every year from that first year. With a 5-year short-term fixed rate option, your interest rate will be locked in for that first 5 years and won't adjust until the 6th year. So depending on your goals and how long you plan to stay in your home and whether you expect to refinance in those first 5 years, that option and considering that short-term adjustable rate mortgage may actually create more stability than the temporary buy down option. Now, they're both tools. So the one that's going to be the best fit for you is just going to be based on your comfort and your timeline. Another strategy that I use to help create more affordability is looking at how we're using your down payment and making sure that we're using that as strategically as possible. If you're planning on putting down 20%, 15, or even 10%, but have some debt, then I'll be looking at the numbers to see, is this actually the most effective use of these down payment funds? Does it make sense maybe to lower the down payment? Yes, pay some mortgage insurance that might be a write-off and pay off some of those either higher interest or higher monthly payment debts. So I look at this from a big picture with how much are you currently paying out of pocket versus how much will you be paying out of pocket, and seeing if we can eliminate some of those monthly debts to increase your purchasing power. And the best part is when we structure it this way, we look at those current debts and we add them in just like they're a closing cost. So during the transaction and up until you get under contract, you just continue to pay your monthly bills like you normally would. Then when we get close to closing, we mark those items to be paid off at closing, and then those accounts will just get paid off after you purchase your home. So you don't have to delay your purchase or even pay anything off ahead of time. Removing even one small monthly payment, or my goodness, a several $100 a month car payment, can dramatically increase your buying power and lower your monthly obligation. This is definitely a pretty effective strategy when used correctly. And my last strategy, well, it's a little self-serving. It's making sure that you're working with a mortgage advisor that uses the right strategy. At the end of the day, affordability isn't solved with one rate or one program. It's solved with strategy, looking at your payment, your goals, your lifestyle, your long-term plan. You deserve an advisor who cares about the entire picture and is going to take the time to walk through the options with you and not give you just some quick yes or no or come back to me later. That's how we make homeownership possible, even in a challenging market. If homeownership feels out of reach, I promise you are not alone. And you're not as far away from it as you think. My name is Amber Jones. I'm a certified mortgage advisor, and I'm here to help inform you, empower you, and help you solve that financial obstacle that you're currently facing wherever you're at on your homeownership journey. I would love an opportunity to have a 15-minute phone call with you to help address all your concerns, answer those questions, and get going on planning those next steps. You can book that call with me using the link below. I hope you found this information helpful and informative today. And if you did, I would love it if you liked the video, subscribed, but most importantly, please share it with a friend. I hope you have an amazing rest of your day, and I'll see you again next time. Bye-bye.